The stock market is continually hitting all-time highs, and yet the economy appears to be in shambles, and nobody can actually go outside to work. So this begs the question, is the stock market going to crash? To be honest, I don't know if this is even the right question to be asking, though. The fact is, it doesn't matter whether or not the stock market crashes. What matters is what we should do to try to either maximize our gains or minimize our losses in the stock market. To start out with that, it's helpful to look at how good humans actually are at predicting whether or not the market is going to crash. According to the annual Guaranteed Life Income Study by Greenwald and Associates and Canex, just 11% of people with $100,000 or more invested in the stock market predicted back in February that we would have a market downturn later this same year. The fact is, professional advisors didn't really predict any better, with only 6% of advisors who manage portfolios of at least $15 million predicting that we would have a market downturn this year. This is despite the fact that we very clearly did have a market downturn. This seems to indicate that investors are really bad at predicting black swan events, where something comes out of nowhere that affects the market in ways people could never predict and ends up making the market go even lower. There was this famous thought experiment by Burt Malkiel, the author of A Random Walk Down Wall Street. He had the idea that a monkey blindfolded, throwing darts at a dartboard, could better predict which stocks would actually perform well than the average stock market. Well, in 2018, a group of students at Chapman University tested this in a way. They blindfolded some of their freshman students, and they threw darts at a financial newspaper. Whichever stocks were hit by their darts, they selected to put into a portfolio, and then at the end of the semester, they compared that portfolio with a portfolio of stocks that just tracked the overall market. Well, wouldn't you know it, the students who were just blindly throwing darts at the dartboard actually ended up outperforming the market. Humans tend to be overconfident in both their own and other people's picks. How many stock advisors would tell you that just randomly picking a selection of stocks will end up beating the market, when even professional stock advisors usually fail to do so? For the most part, it's in people's best interest to just follow the herd, and because of that, a lot of our thinking kind of revolves around this herd mentality. And I think it's the same with the market. When the market is white hot and it's shooting up and you're seeing all of your friends make a ton of money in the stock market without knowing anything about stocks, without doing any research, you start to think, wow, maybe I should get into the stock market because I'm missing out on all this money they're making. Well, eventually you get into the stock market, and wouldn't you know it, right when you get in is at the peak of the stock market. Later, when the market crashes, most people end up trying to hold on to their money. They're like, okay, the market's dropping, but it has to go up at some point. We've already hit the bottom. I'm going to keep on holding. And then they slowly see more and more people exiting the market, people losing all their money, until finally they think, okay, I can't afford this anymore. I'm pulling my money out of the market. And guess when this usually occurs? Right at the bottom of the market. This is kind of the idea behind a famous quote by Warren Buffett. Be greedy when others are fearful, and be fearful when others are greedy. So how do we know when others are being greedy? One way to do this is to look at the PE ratio, or the price to equity ratio. Now, for your average publicly traded company, this is usually around 13 to 15. And so if we look at the S&P 500 as a whole, we can compare how well the market on average is to those numbers to see if it's overvalued or undervalued. So like I said, we would expect companies in the S&P 500 to have a PE ratio of around 13 to 15 on average. Currently, that PE ratio is 29. This is an indicator that the market is overvalued. But here's the next problem. If everybody knows that the PE ratio is so high, why are they still paying that much for these stocks? Anybody paying more than that would know that they were getting ripped off, right? People are saying with their words that the market is overvalued, but their actions are saying differently. And actions are what actually matter. The fact is, if people are currently invested in the stock market, their actions indicate they don't think the market is overvalued. So then that begs the question, why might that be? How could it not be overvalued with a PE ratio that high? Well, a good possible explanation is that the majority of the market thinks that the PE ratio isn't reflecting how much companies have in earnings currently. Instead, they're looking at how much those companies will produce in the future. A lot of companies have taken big hits to earnings over the last couple months. But does that mean those companies are suddenly worth that much less? Because they still have the same potential to make money once the current headwinds disappear. So doesn't that mean that they should be valued a little bit higher than they were before? But then how much higher? Should it be nearly double as high like it is right now? These are questions that it's a little bit harder to answer. So in that case, what's a different indicator that we can use? Well, one indicator we can possibly look at is the media. I think this is an indicator that a lot of people rely on, even if they don't consciously realize it. When you see news stories coming out that say the market is either overvalued or undervalued, those can definitely sway your opinion. So it's important to look at what techniques they use to try to sway your opinion so that you can make an informed decision on your own. You may have seen some stories recently that the market is at an all-time high. And then this is followed by a story which talks about why the market is overvalued and why it's going to crash soon. But here's the problem with that. If you look at the market's performance from 1915 until 2017, 1 in 15 of those days had an all-time high for the market. The fact is the market moves up on average around 8% every single year. And when you have something that's moving up on average, you're going to have a lot of all-time highs. It doesn't mean the market is necessarily overvalued. As a matter of fact, when you really dive into the data, all-time highs don't indicate that the market is usually going to crash. They actually usually indicate the opposite. If you were to put money into the market just on the days that were all-time highs, 70% of the time in the year following, you would have made money, and only 30% of the time would you have lost money. If you bump this up to 3 years following the all-time high, 76% of the time you would have made money, and only 24% of the time would you have lost money. Over a 5-year period following each of those all-time highs, you would have averaged around a 32% return on investment. This means that if you pulled your money out whenever you hit an all-time high, you would have missed out on a lot more money than you would have saved by avoiding potential crashes. So what does that mean for you now? The question is it worth staying in the market to get potential future gains at the risk that the market might crash? Well, there was a Merrill Edge study which looked at market performance from 2009 to 2018. If you had invested $1,000 in the market from 2009 to 2018, you never pulled the money out, you never did anything with it, you would have had around $3,500 at the end of the study. However, if you had missed just the 10 best trading months of that time, you would have only returned $1,500. If you had missed the 20 best months of that time, you actually would have lost about $42. When you try to time the market, you have to be right more than 50% of the time to actually be successful. So let's think about how that data applies to today's situation. There's two possible futures for the stock market. One, the stock market continues to rise. If you pull your money out in that case, you miss out on a bunch of potential future gains. The other, the stock market crashes. And if you pull your money out, you avoid all those potential losses. Luckily, we can compare to 2007 to compare to a worst case scenario to see what would happen if the market actually did crash. If you had invested all of your money in 2007, right at the peak of the market before it crashed, the S&P 500 was valued around $1,550. If you then kept your money invested and rode out the entire crash and the way back up, it took about 5 years to actually recover the money that you would have lost, but all that time since then, from 2012 until now, all of that extra appreciation would have been gains on top of what you had back in 2007. This is a good way to explain the fact that short-term investing is much riskier than long-term investing. For example, right now, if you need some of the money that you have invested within the next 5 to 10 years, it's probably a safer bet for you to pull money out of the market because if it crashes, you're not going to get that money back anytime soon. On the other hand, if you can afford to keep your money in the market for 5 to 10 years, chances are you'll come out ahead by leaving your money in the market. So now the last thing I want to bring up on this topic is the importance of your mindset. Now I'm not trying to get too wooey here or like Grant Cardone, 10x your mindset or anything like that. All I'm trying to say is how you think about things affects the decisions you make. For example, back in 2016, if I had listened to all these different articles that were repeatedly saying the market is overvalued, it's going to crash soon, if I had pulled my money out of that market, I would have missed the 42% that the S&P 500 has gone up since then. This means that if the market crashes and drops 20%, I'm still ahead of where I would have been in 2016. Similarly, if I'd invested all my money back in 2008, right before the market crashed, the worst possible time to invest, I still would be up around 57% now over where I was then. At the same time, there were a lot of people who ended up selling out of the market after it crashed. And then they stayed out of the market even after they saw it going up because there were fears of a double dip recession happening. Then, after a few more years passed, They started thinking, well, the market's already gone up so much, it's got to have a correction at some point. I'll wait for it to drop and then I'll buy in. But the market just kept continually going up and going up and going up. And they missed out on that entire period because they were afraid that it was going to crash. Those individuals are going to have a very hard time ever becoming wealthy or possibly even retiring at all. The fact is, there are consequences to the stock market crashing, yes, but there are also huge consequences to pulling your money out of the market because you're afraid. That's the point that I want to emphasize. Don't just focus on the fact that you're trying to avoid a potential crash. You need to be aware of the opportunity cost that you're undertaking whenever you pull your money out of the stock market. Now, it's very good to be a cautious investor. I personally keep 3 to 6 months worth of expenses in an emergency fund at all time, and I never invest anything in the market which I'm going to need within at least the next 10 years. This makes it so that I don't have to worry about the market turning down suddenly. I can ride out those waves and think with a longer term mindset. This is really important to being successful in the stock market. Investing simply is a long game. And if you want to be successful at it, you have to have a long-term mindset. Now, if you're interested in investing and you haven't really looked into it that much, there's a couple good places to start. Investopedia has a really good article which teaches you kind of the basics of investing. I have a video which I can link which talks about what you should invest in as an absolute beginner. I also have another video where I talk about the do's and don'ts of the stock market. If you don't already have a stock trading app, probably the simplest ones to use are the mobile apps that are out now. One that you've probably heard of is Robinhood. If you sign up with the link in my description, you get a free stock, and then I also get a free stock when you sign up. A similar one is Webull, where again, if you sign up, you get a free stock, and if you deposit $100 or more, you get a second stock valued up to $1,400. The last good option is Acorns, which is kind of designed for investing your spare change. That one, if you deposit $5, you get a $5 bonus. With that said, I hope you enjoyed this video. If you did, make sure to leave a like. And if you want to see more videos like this in the future, make sure to subscribe. I'll see you next time.